Well, the year is all but done, and so it's time to take stock of some of the hits and misses of 2024 on the JSE. Pick and Pay had investors glued to corporate action and its turnaround plan as it fights it out in the grocery retailer war. And Italtile still battles with a weak consumer pocket and tough competition. These two counters caught the attention of Keith McLachlan from Integral Asset Management, and earlier I caught up with him to find out why. Let's take a look.
There's only two animal spirits that matter in the market: bulls and bears.
Yes.
But in terms of Pick and Pay, I mean, it's an interesting one. Perhaps to set the scene with context, is Pick and Pay's come from about let's be generous and call it a decade of mismanagement to arrive in the position where the core business that was once a flagship mid to upper retailer in the non-discretionary space across South Africa was really loss-making, and in fact their very small investment into the low LSM retailer being Boxer was in fact their biggest investment. And from a series of management changes, they arrived at the point where they realized they need to do something, and therefore we hit their two-step recapitalization program to position them for the turnaround, and that's where we are this year. And the two-step was a 4 billion rand rights issue, which, talking about investor appetite, was oversubscribed, and that's always a good sign. The second thing was they then took Boxer, that had always actually been run independently and by all appearances run very well independently, and full credit to Pick and Pay for holding it and full credit to the Boxer team for managing this, but took Boxer and effectively IPO'd about a third of it. Pick and Pay, in fact, the SENS came out earlier today, today being the 10th of December. I know this is a pre-record, but that Pick and Pay is left holding 65.6%.
Yes.
So let's call it two-thirds.
Yeah.
And by listing Boxer, they realized about 8.5 billion in terms of capital. The combination of the rights issue and the capital realized in the Boxer listing arrived in a position where they have net cash in the balance sheet. So what do we have? Well, we have a loss-making retail operation, but a loss-making retail operation with 70 billion in annual turnover, which is a significant number. It's got a large footprint. This is a business that, if you can get it right, could in fact generate quite significant amounts of profit. And then a 65% shareholding in Boxer that at this point is worth about 19 billion rand. Pick and Pay is trading at 22 billion rand market cap. So in fact, the market's only giving it credit for 3 billion rand, but that's roughly, let's argue, a little bit less than the net cash they hold in their balance sheet. So if anything, the market's giving them a negative fair value in terms of the turnaround. So where are we in terms of appetite? I think the market is very clearly backed Boxer and still remains undecided on Pick and Pay's turnaround. And that's, just to one. And sometimes share prices say more than these long-winded narratives that I just did. Pick and Pay might be up 50% year to date, but in fact, over a 5-year time period, it is down 50%, including this move this year. So really, next year, and probably the next 2 to 3 years, is all about, can Pick and Pay use its net cash position to turn itself around?
And that's the thing, because the main question remains, can they get it right? And I guess we'll only be seeing this when we look at their financial results for maybe the next couple of periods. But also, I mean, just leading back to my question, because I mean, we have had this turnaround being implemented for a while now, and Sean Summers coming to say that they are starting to see some green shoots there. Even in some of the financial metrics, we have started to see an improvement there. And I'm wondering if maybe there could be a turnaround from a kind of loss-making position to a little bit of profit, maybe sooner rather than later.
So this is going to be very hard to call in terms of probabilities of success and everything, but conceptually, one, you have a company that has sales, so you're not going out there to find sales. 70 billion of sales, let's be very clear on that. That's a big number. Two, you've got a footprint. So you've got distribution, you've got DCs, you've got footprint, you've got operations. This is a question about getting your margins right, such that you have a sustainable bottom line. Now, the third aspect of this is your balance sheet has been sorted. What I mean is you're no longer in a net debt position, you're in a net cash position, which buys you significant time. It gives you ammo to go and apply, because typically some of these things, for example, a store footprint where maybe 20% of your stores are loss making, you sign maybe 10, 20-year leases on these stores. How do you get out of these loss making positions? Well, you've got capital you can apply to that. You can literally buy your way out of those leases, close down those loss making stores, consolidate your footprint to where you're profitable. And by spending your cash, investing your cash wisely, streamlining your operation, focusing on where you're profitable, you can hopefully in 2, maybe 3 years' time, arrive at a position where slightly smaller, but profitable retail operation. Now, it is hard to know as an outsider without a granular view at store level, but this is definitely a better position to be in than many turnarounds I've seen. You've got sales, you've got size, you've got net cash on the balance sheet, and you've got new management, which I haven't touched on. You don't want the same management that messed this up to be around trying to fix their own problems. You need a new set of eyes. You need new people looking at this, such that there's no ego on the line. They can cut where they need to cut and make the hard decisions they need to make. So Pick n Pay's in a better position than most turnarounds, but that's no guarantee, and that's important to note. And in fact, the market giving them arguably a negative fair value, stripping out Boxer and net cash from their market cap, is the market being pretty pessimistic on the outlook.
So would you say that at least in the short to medium term that maybe there would be a bear spirit applied there instead of a bullish spirit? Also considering the fact that you talk about, I mean, they must get these margins right as well and elevated and comfortable, but also looking at the tight competitive landscape that we have in that grocery sector.
Certainly. So, I mean, the competitive landscape is definitely a lot more competitive than it was 10, 20, 30 years ago when Pick n Pay was the 500-pound gorilla in the room. It's no longer. So it's playing against some very serious competitors that are very well capitalized and arguably infinitely better run than it is. I do think, and you can look around certain case studies around the world, I do think if you get the basics of retail right, cut out your loss making, focus on what you're good at, figure out what your value proposition is to customers, you can get the basics right. I think I'm a little bit more optimistic than the market is giving them credit. I don't think a negative valuation is appropriate at this point for their operations, but we will see. Just because they have the odds on their side or higher probabilities than a typical turnaround because of their more advantageous position doesn't mean it's a certainty. This can still go wrong. Luckily, though, we're in an environment where lower inflation, we're in an environment with dropping interest rates. Hopefully, these things support consumer discretionary spend, consumer disposable income. We're also in a position where if they were to exit leases, there feels like there is quite a lot of reletting activity that could slot in. So landlords might be a lot more forgiving on exiting loss-making leases and consolidating footprint. You know, a little bit of good luck, some macro tailwinds does not hurt when you're in this space.
Well, talking about forgiving, Italtile recently released a 5-month sales update. And actually just looking at those numbers, they didn't look great. No. But actually looking at the share price reaction, it seems like there's very little negative sentiment applied to that stock. What exactly are investors holding on to here?
I think there is perhaps might be a dual view of the positive sentiment in South Africa and all the macro things I just spoke to in terms of Pick n Pay, dropping interest rates, low inflation, and I haven't even touched on the positive political landscape that is improving, et cetera, all these things playing into the home improvement and building segment. And Italtile is such a strong and dominant, let's not use the word monopoly, let's use the word dominant player in this space as the integrated tile and ceramic provider, that they should be a beneficiary. I mean, just to give you some context, if you go into any toilet or bathroom in South Africa, somewhere between 4 out of 10 to 6 out of 10 of the tiles and ceramics in that bathroom probably was sold by Italtile and all subsidiaries and all franchisees of it. They're really, really dominant.
Yeah.
But I think the problem is, and herein lies the problem,
Yes.
is that as an integrated provider, they've got a manufacturing half. The manufacturing half, the competitive landscape has arguably permanently changed. A $100 million Chinese competitor has been dropped just across the border in Maputo, and we have excess supply of particularly tiles in South Africa. And as the manufacturing side, you're immensely volume sensitive. You could see that their retail side in the 5-month statement you spoke about is holding their own, 2.2% revenue growth. Not spectacular, but defending its own. The pressure really is in the manufacturing side, where you've got negative volume growth, and because of operating leverage in those huge fixed cost operations, I tremble to see what the bottom line is going to look like. But like I said, I feel like those dynamics have shifted. Italtile's up 30%. The share price is up 30% year to date. I think these numbers are going to disappoint. If there is another play here, the play might be it's an 11 times multiple that's gone, despite being a really well-run business. It is a family-owned business. And this might be a delisting target. So people might just be positioning themselves for a potential delisting. I think they're going to be disappointed in terms of that. I think the family quite likes having the business listed. So that's not going to happen either. So far less optimistic than the market on Italtile here. So quite different to my view on Pick and Pay.
That's actually pretty interesting. And I mean, you also talk about I mean, they call it the predatory pricing environment that they are experiencing because of the huge competition there where there's oversupply. Are you saying at this point, even good economic growth that could maybe overturn the cycle of the building cycle, maybe won't be able to overtake the kind of pressure that they're experiencing from competition?
Well, that's a good question, Zanati. I mean, roll back to 20 years ago, 15 years ago, when we had 5%, 6% GDP growth. I mean, a few people can remember those good times, but the build up to the 2010 World Cup, and it really makes a difference when your GDP per capita is growing. What that means is your GDP is growing faster than your population, particularly lowering interest rates, and there's big public sector fixed capital formation, private sector gets confidence. Never say never, but that is not anytime soon. And if that happens, that'll happen gradually, and we will see that coming, 6 months, 12 months, 18 months out. If anything, I see a grinding. South Africa's had a shift in trajectory, but a shift in trajectory isn't the same as 5-6% GDP growth. Whereas a Chinese manufacturer that has just built their $100 million factory across the border in Maputo, they've just opened their doors. They're probably going to fund losses for who knows how many years. You need this growth to happen sooner rather than later for this dynamic to shift in favor of Italtile. In the absence of that, predatory pricing is likely to remain. Volume pressure, pricing pressure. This is going to be an immensely difficult environment to operate in. And we haven't even touched on the fact that their factory, the manufacturing side, is very dependent on Sasol's gas pipeline in, and we've got a gas cliff that's potentially coming as well. There's all sorts of existential threats around this manufacturing operation that could be a drag on the group for time to come.
That was Keith McLachlan from Integral Asset Management. And that's all.